Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined today by three of my colleagues, my two co-hosts, Chris Dorides. Chris is the deputy chief economist. I can see him smiling there in his office. And Ryan Sweet, director of real-time economics. Ryan, never really smiles, but no, even there. It's a
I
frown.
always smile.
I see a frown. Okay.
It's not frown.
Yeah. And then we've got Damien Moore. Damien, this is a colleague of ours at Moody's Analytics. Damien, this is your first time on this podcast. Welcome.
Hey, Mark. Thanks for inviting me, and hi, everyone.
And everyone can tell you have an Aussie accent. Where from Australia are you from?
So I grew up in the capital city, Canberra. So did all my education and undergraduate education in Canberra. I moved to Sydney for about 5 years, in part while I was doing my graduate studies in the US, and I studied at Northwestern in the US. So then I've been back and forth to the US and Australia ever since.
Oh, there's this spy TV series. It was Netflix or centered in Canberra. Have you seen this?
I haven't seen it.
No?
So I'll have to check it out.
Yeah, it's kind of the dynamics between Australia and China and Russia and US mixed in there as well. But it's these kind of the vexed relationship that the spy community has, I think, with each other.
Yeah, it's very interesting times right now.
Canberra is really a beautiful place. I've never been, but judging by the TV series, it looks great.
It's great. It's great if you like to exercise, because there's bike paths everywhere. It's a planned city, and it was originally planned for a lot of foot traffic, so you can jump on a bike and ride pretty much anywhere. And it's a big sprawling city too. Like, it doesn't have a really built up central business district or anything, so it's great for exercise.
And the weather good?
It's definitely a little cooler than Sydney. It's inland, so you don't have the temperate effect of the ocean and so on. It's a little further south than Sydney too. So, but it's nice pretty much year round. It's a little cooler in the winter time, but you get the 4 seasons much more than you do further north.
Yeah, very nice. And so you went to Northwestern. Is that where you got your PhD in Northwestern?
Yeah, it is.
Oh,
it is. It was a lot. It was an extended thing because I took an academic job in Australia for a while during that process. So then I was kind of back and forth to the US and back to my job at Sydney while I was teaching.
And you were you in financial? You're a financial economist.
So I was in a business school when I was teaching. I taught finance department, and taught sort of the standard financial stream courses: corporate finance, investment theory, options pricing type stuff.
Right. And then how'd you find your way to the way we met? A long time ago now, was you were at the Congressional Budget Office, the CBO, the nonpartisan group that does the budgeting for the U.S. How did you get there?
That's right. Well, I always had an interest in policy. I'd actually done some time at a consulting shop in Australia, in Canberra, who did a lot of the budget estimates. So I had some familiarity with that type of work. And then my dissertation advisor, Debbie Lucas, had worked with CBO on and off.
I didn't know Debbie was your. I guess I knew that and I forgot that. I see.
That's right. So she was chief economist at CBO for a while, and then left. And then I told her I was sort of interested in getting out of academia, and she said, "Well, you should look at this policy shop because it's a great place to work." And so I interviewed with them, and it went well, and spent 10 years with them, more than 10 years.
Yeah. Well, Debbie is the godfather of, I guess that's okay to say, the godfather of fair value accounting, isn't she?
That's right.
Are you a disciple of the fair value accounting method?
In part.
Yeah, I can't.
Probably in large part.
One of these days, I got to tell you my theory on fair value and how to improve it. I'm curious. Maybe I've already told you this, and you kind of looked at me. Have you noticed, guys? Damien never disagrees with you. He just kind of looks at you and doesn't say anything, and then looks away. That's kind of the way he handles it? Have you noticed?
That's when you know you're wrong. Yeah.
That's when you know you're wrong. That's exactly right. Yeah.
I'm an agreeable person as a rule.
Very polite.
So it's hard for me to openly dismiss an opinion.
Well, since we're on TV series, have you guys watched, and I'm not saying I like this all that much, but every once in a while, The Witcher. Have you seen The Witcher?
Nope.
It's a little too fairy tale-ish for me, but The Witcher, you remind me a little bit of The Witcher. The Witcher just kind of He doesn't say very much, and he kind of grunts, you know. By the way, that's a compliment. If you want to be the Witcher, yeah.
Okay,
He's
all
a good
right. Well,
guy.
good to hear because I haven't seen that
Yeah,
show. But...
very smart, and he kills all the monsters, so that's all good, you know. So and then you joined us. How long ago now has it been?
It's coming up for 5 years.
No
Unbelievably, it's gone
way.
pretty quick.
No way. Oh, that's amazing. And I know your youngest is 5, right? It's got to be 5, right? Because I remember your boyfriend
Turning 5 this year, so he's 4.
He's 4.
He,
Okay.
he
Yeah.
turned 4 back in November. So
Yeah. Oh, that's right. Okay. Very
yeah,
good.
he
Well,
came during my first year, and he came early.
I remember that.
Which was a
You
little
just
hair
joined
raising
us,
for
and then all of a
everybody.
sudden you were kind of in a difficult time, but it all worked out. That's good.
That's right.
Yeah, very good. Well, we're just thrilled to have you here on Inside Economics. I know I've been trying to get you on for a while, but you've been resistant. But you're here. That's
Yeah,
good.
because you have me doing lots of other things, and I juggle a lot of responsibility
That is true.
for our
That is
market
true.
risk clients.
That is true. Absolutely, you're a busy guy. I
Yep.
appreciate you taking the time out. Hey, we're going to do a few things here. One is we're going to talk about, well, the statistic of the week is the consumer price inflation. It feels like, you know, hair on fire. We got to talk about that. Then we're going to go into our statistics game, and I'm guessing a lot of that's going to revolve around this consumer price index as well, but who knows? Damien's definitely going to try to trip us up here on the game, and everyone knows the game, right? Each of us come up with a statistic. The rest of the group tries to figure that out. The statistic can't be too hard, too easy. Got to be related to the topic of the day, and come out in the past week. Although for the guests, they don't need to stick to that religiously. Ryan has to follow those rules. Everyone else can kind of do what they want. And then we're going to talk about interest rates, and that's wow. Do we have a lot to talk about there? I mean, just looking at that 10-year Treasury yield over 2%, that's something to talk about. So that's the game plan. So let's dive right in. Hey, Ryan, give us the lay of the land on the, whatever you think is important, but I'm guessing it's the consumer price index.
It is. So the consumer price index for January came out this week, and it increased a lot more than economists were anticipating. So the consensus was for a 0.4% increase month over month. So December to January came in at 0.6. That raised the year-over-year growth from 7% to 7.5%. And that's what's getting a lot of the attention in the press. But when you dig through it, price pressures are broadening. The only components that fell in January were energy related, and that's temporary because energy prices have moved back up in February. So we should see energy add to inflation over the next couple of months. But if you strip out volatile food and energy prices, so the so-called core CPI, that was still up 6% year over year, which is the highest since the early 1980s. So that's garnering a ton of attention. So Mark, I knew you would want me to update this. So remember the average increase in household expenditures with inflation at 7.5% versus 2%.
Yeah,
$276 per month now. So there are real economic costs to inflation.
Well, that's good to know you got to 276 because I got exactly to 276, but I rounded to 275. So
you got to go 270.
Got to be
precision.
276.
Precision.
Okay. Yep. All right. Yeah. So that's the typical American household. That's the household making, let's say, the median income, which is probably close to 70K, 65, 70K, is now spending $275 more a month to buy the same goods and services that they were buying a year ago.
Correct.
So that's a lot. Just think about that for a second.
Yeah. It adds up quickly. And that's why we saw Michigan consumer confidence came out this morning. That dropped a lot. That's some of it, if you look at the details, is inflation. The other part's interest rates.
Yeah. Okay. You were a bit surprised by the CPI. You had expected, and you're really good at this, you put expectations together, 0.4% month to month increase in CPI, consumer price index, and a 7.3% year over year, or was it 7.4? Yeah, something like that. I think we're stretching this a little bit, but I'm just curious, what in the report came in more hot than you expected? It had higher rates of inflation than you expected. When you go into the specific goods and services.
Yeah, so I thought you're going to get a lot of weakness in some of the services that were tied to the pandemic. So airfares, for example, I thought they were going to drop. They increased. Lodging away from home wasn't as weak as I was expecting. So it doesn't seem like the Omicron variant was as disinflationary as the Delta wave was on some of these components of the CPI. And then the other thing is amateur mistake. I used I didn't use the updated weights. So if you did that, I would have been a little bit closer. Still wouldn't have gotten 0.6, but it would have been closer.
Just to bring folks up to speed, so Bureau of Labor Statistics, the agency that puts the data together, every year, I guess, or is it every 2 years?
Every 2 years.
Every 2 years, updates the weights that they attach to each of the individual components of the CPI for all the various goods and services. And those weights are determined by consumer spending patterns. So if I am spending more on, a car or a consumer electronic or going out to a restaurant, it gets a higher weight. And something else has to reduce because it adds up to 100%. Mm-hmm. And with the January 2022 CPI report that came out yesterday on Thursday, the BLS updated the weights using 2019 and 2020 average consumer spending patterns. And that's what you're referring to. And the reason that had an impact was because that includes the pandemic, 2020, and we spent a lot more on goods, a lot less on services. And of course, goods prices are rising a lot faster than services. And so it causes this measurement change, and that's what you're referring to. And exactly. By my calculation, that was worth a couple tenths of a percent on year-over-year CPI. So that could simply be the difference, right, between the 7.5
it is the difference,
right?
I was thinking, right. Yeah, I had 7.3. Add those 2 tenths in to get 7.5, which is what we got. Yeah,
I should say, right here's a good place to say it. We are going to record what we're going to call a mini podcast or a data deep dive. And it's going to be 10, 15, 20 minutes where we're going to go deep into the bowels of a report. And the first one's going to be on the CPI. So we'll probably go over this again when we do that mini podcast that we'll post tonight along with the podcast that we're recording right now. So this is an experiment. I'm really curious what people think. If they find it's really, really wonky. Damien, you'll love this. I know you'll love it.
Sounds good. I hope there's video.
There's definitely video.
Oh, there's always
definitely
video.
Yeah, definitely. I guess we got to change our what we're wearing for the deep dive. I'm not sure. No, we're good as we are.
We're good.
Okay.
You want some charts, Damien? What do you mean? You just want to see?
If we're going to talk numbers, we got to have some tables, right?
Oh, that's a good idea. He's got a point. Maybe we'll whip that up. We'll whip up a couple.
Yeah, we'll figure it out.
Well, maybe you give a link.
Give a
link. Check it out.
Still a podcast, though.
Yeah, right.
We should have him more often. He's like a fountain of ideas. You notice this?
Yeah, and I have a feeling all these ideas are going to end up on my plate.
Fall on Ryan's lap. That's where they belong.
Yeah.
That is actually a pretty good point. Yeah, that's right. Hey, Ryan, can you help us out with that?
Yeah, let's get some tables. Yeah,
hey, put some tables together. Yeah, you're good at that. Okay. No, promise not that I won't do that.
No. But I think we're one last thing on the CPI. I think we're at the peak. If it doesn't peak in February, or that wasn't 7.5, wasn't the peak in January, February will be the worst.
Well,
the worst of it.
Even with energy.
Yeah, I was going to ask about that. Yeah.
Well, that's why I'm thinking February. Like initially, we were thinking January was going to be the peak. I think February is the peak, and then after that, we'll be on the downside.
And by the way, I say that we've already peaked. That this year-over-year stuff is very misleading.
Oh, it is.
Because there's base effects. I mean, last year this time we were coming out of the depths of the pandemic. Businesses were still slashing prices. Inflation was incredibly low, close to 1%. So you get these year-over-year, what economists call base effects, which, by the way, is going to be working in the opposite direction a year from now, pushing down measured inflation. So, in this kind of, when people are trying to gauge, are we, kind of moving in the right direction here on inflation, we should be looking at month-to-month, I think, changes in inflation. And that actually peaked back in October, and that was in the depths of the Delta wave of the virus. And that goes to my narrative. I'm curious what you guys think, but my sense is that the acceleration in inflation that we've observed in the last several months, the last 6 months or so, where it's gotten uncomfortably high. This is top of mind high, is related to the supply side disruptions to the economy due to primarily the Delta wave of the pandemic. When that happened back in the summer and fall last year, it completely upended global supply chains because that creamed Asia, Southeast Asia, where all the supply chains begin. And it really disrupted labor markets, again, because people got sick or had to take care of sick people or were fearful of getting sick. So that created all these labor shortages, caused wage growth to accelerate, particularly for low-wage workers in industries that had gotten directly hit by the pandemic. Think restaurants or leisure hospitality, recreational activities, that kind of thing. And also just scrambled demand and supply dynamics in other markets like the oil market and the natural gas markets. And that's what's behind the current very high inflation. And if you buy into the idea that the pandemic is going to wind down going forward, that is, each new wave of the virus, and we'll probably see more waves, is less disruptive than the previous wave to the economy, to the healthcare system, that we'll see inflation moderate. Not quickly, because ironing out these supply chains and labor market and dynamics or it's going to take some time because it's a mess out there. And other things are kind of adding to the mess. Think, the Canadian truckers, stopping stuff coming over the Ambassador Bridge. But as the pandemic fades, inflation will fade. That is the core to at least my thinking about where we're headed on future inflation. What do you think of that narrative? And anyone disagree with that or want to push back on that?
No, I think the data supports that view. If you look at U.S. manufacturing surveys, they have a component called a supplier delivery index. So when that is increasing, that indicates slower deliveries. So all of them are improving. They're heading in the right direction. And we maintain this U.S. supply chain stress index, which basically just takes a bunch of indicators that are related to supply chains, so shipping costs, commodity prices, match them up, make an index out of it, and that's coming down. We do the same thing for APAC, Asia Pacific, and that's improving as well. So, I may or may not have another number for you that supports your view.
Yeah. Okay. Well, that makes sense. Chris, anything we wanted to say on that?
I would say broad strokes, I'd agree in terms of the pandemic, but there are other risks that are emerging, right?
Yeah. Okay.
Yeah, there you go.
Here comes the pushback. Go ahead. Fire away.
The energy, as we mentioned, you got Russia, Ukraine, you got some other risks, geopolitical risks out there that are building. I think that's going to cause energy prices to remain high for a while, because I don't see that being resolved quickly. And then I more technically, I'm focused on the rental prices, right? Rents they're going to continue to support inflation or drive inflation higher for a while. So that maybe I could buy in. Yeah. If there's no other wave and the energy doesn't get too far out of whack, we could be at peak and things continue to fall. But I think it'll be a slow, gradual decline versus something very immediate.
Yeah, those are good points about energy. In fact, we have it seems like another advertisement, sorry, but we got a podcast coming on Tuesday on the Ukraine-Russia kerfuffle. I guess that's not even conflict. We're going to be talking about that, and certainly about what it means for energy markets and prices. So that's coming on Tuesday. And I hear you on rent growth. That's clearly going to be an issue for a while, given the very severe shortage of housing, which is just juicing up rents. Hey, Damien, anything you want to add on that? Any pushback on kind of our, I guess, generally sanguine view on inflation?
Maybe more of a question is, do you think the latest, like the month over month, is that roughly in line with where you're thinking it would come out, or is it a little higher, a little lower? Is it giving you a sense that the price pressures will come off sooner than you might have thought, or take longer?
Well, no, I'd say like Ryan, I was a bit surprised by the 0.6% increase month to month in January. I thought it would be, I was thinking it was 4 or 0.5%. But I do think part of that is that measurement issue. I mean, it's 0.2% year over year, so that's a bit of an add every month along the way. So, and it probably had more of an impact on January. But I was I'd call out the one thing that I was surprised by, and in ex post, I probably shouldn't have been, but I was surprised, was the big increase in electricity prices, which totally makes sense, right? Because electric utilities are facing higher input costs, higher natural gas prices, and not a lot of oil-fired electricity, but it adds to the pressures. And we saw a really large increase in electricity prices. That
Also
was,
weather.
Oh, you think? Oh, I didn't. Oh,
Yeah,
that's
weather
probably
can factor
right.
into
Weather.
that. Yep.
You're right. You're probably weather too. Yeah, I hadn't thought of that. So that surprised me a little bit. So I explained the gap between what I expected. So my thinking about where inflation is headed as a result of that January report has not changed. But when I say that, when you're when you're forecasting and you're thinking you're at an inflection point for anything, it's really tough, right? Because you're in the middle of the data and the data's screaming something and you're saying, no, it's going to change. But, it just makes you uncomfortable and makes you less confident in what you're saying. So I'd have to say I'm less confident, but I'd say that's just a natural state of affairs when you're at an inflection point for something you're thinking is going to turn, like inflation.
Yeah, I hear that. I hear that, definitely.
Yeah.
And what about wage pressures? You think that wage pressures won't start to kick in and push inflation further?
Well, I'd say I'm worried about it. By saying my baseline view, this goes back to the disruptions to the labor market related to the pandemic. As the pandemic fades and people get back to work, particularly in those industries where wages have really gotten juiced, it's all in the leisure, hospitality, restaurant, recreational activity, healthcare, education. These are where people have not gone to work because they're on the front lines. I mean, those are the folks that are interfacing with they're not you and I sitting in our office in our home and not being exposed. But they're exposed every day. So as that settles in, I expect that wage growth to decelerate. And if you look at the Atlanta data, the Fed wage tracker data, which is, in my view, among the best wage data we have, the acceleration in wages has really been in the bottom half of the wage distribution for young workers, for workers that are less educated in those industries. So as the pandemic fades, I expect that wage growth to moderate. But having said all of that, that's definitely a worry that the longer inflation remains high and persistent, and particularly those gasoline prices, because that we can see that really affects people's thinking, and I'm sure they're going back to their boss and saying, hey, you got to pay me more because I just filled my gas tank for $50, and if you want me to come to work, you got to pay me more. So the longer that sticks around, the more I worry that wages and prices start to feed on each other, and then that's a whole different world of hurt. So we're not there yet, but I worry about that for sure.
Yeah, that's my main worry.
That's your main worry. Yeah, I agree with you. Okay, let's a lot there. Let's we can keep going, and we probably will when we come back to talk about interest rates. But let's go to the game. Let's go to Chris. Chris, let's go to you first. What's your statistic this week?
All right, we're gonna have some fun.
Oh, no.
12.2% and 2.8%.
12.2% and 2.8%. Okay. Does it have to do with the CPI report?
Yes, it does.
Okay. Is it year-over-year inflation for certain components of the CPI?
Yes, it is.
Okay.
Or-
Okay. So he's got to be clever here in some way that, he can't pick some wacko esoteric down into the bowels. Okay. Would the 12.2 and the 2.8 kind of define certain points in the distribution of price growth across goods and services? Boy, that's a mouthful.
Oh.
You understand what I'm saying, though?
Kind of, sort of.
Did you go coffee again?
I did not go coffee, but
gotta be a
9.3%.
food.
What the heck? What the heck?
What?
You think it's
9.3%.
some food price. Okay. He's being clever. He's being clever.
Yes,
It's got to be
it
clever.
is 2 food prices.
Oh, it is 2 food prices. And
Oh,
so
meats. Is it meats?
Meats is one,
All
12.2%.
right. That's 12. Yeah, I was up.
hot dogs.
Nope.
Because you have kids at home, right? Do you guys, when I was a kid,
Oh,
I'm telling
Here
you,
we
this
go.
is true. This is a
Here
true
we go.
story. When I was a kid, there were, I have 3 brothers and a sister. I'm in a big family, and my dad made a good living, but you know, he wasn't a wealthy guy. He get paid, I think once a month, and then by the end of the month, we're running out of money. And the reason I know that is because I'm having hot dogs, 4 days out of the last week. I'm having hot dogs. By the way, I love hot dogs.
Hot dogs are the best.
They're the best. They are the best. But we're not talking hot dog. Okay, what are we talking
Absolutely.
about? Okay, Damien, do you know what he's talking about? What food is 12.8% food item is up?
2.8. 2.8.
Oh, 2.8.
Oh, only
12.2 and 2.8.
12.2 is meat. Wine?
Ice cream.
No, no.
No, because I heard ice cream.
I was trying to be clever.
Yeah, no, he's trying
Not
to
just some random product.
It's something in Wawa. Think Wawa. It's like,
Nope,
buy these
not
two
water.
things.
Yeah.
Huh?
Do you give up?
Yeah, I give up because we
No,
went
wait,
wine.
that's not-
we went coffee.
Wine? What are you
Yeah, I was
talking
thinking,
about? Wine?
Chris.
Oh yeah. Is it like his
Wine is
yeah.
close. Wine is a good one because
Oh, it
alcoholic
is.
beverages were 2.7. But
Was that what you
It's-
meant? But that was
Nope.
2.7.
no,
Oh.
I said 2.8.
Are you going early Valentine's Day? Are you going chocolate?
No, I think you're way off.
Oh,
Oh, that
that's a-
would have been good though.
That would have
That's
been
good.
good.
That is a good one.
Yeah,
Is
Damien,
chocolate a
any idea
category?
here?
I don't think they.
No, I
What
have
about,
no
what
idea.
about produce? What about produce? Like fruit and
Oh,
vegetables.
there you go. There you go.
Hold on, wait.
Vegetables. He
What
got
are
it.
those?
I think there's a cowbell.
No, wait,
Oh,
hold
here.
on, hold on. What? I'm way behind
is
here.
that?
What is that? What are you
Produce?
talking about?
Vegetables. Fresh vegetables.
Oh, fresh vegetables.
Produce.
I didn't hear Damien say that.
Oh, I thought he said pierogies.
I thought that's what I said too.
Really?
He said pierogies.
Yeah.
He said
Is my
pierogies.
headset
You
going
gotta
bad?
be tuned into the accent. Come on.
Yeah.
Oh, you said vegetables.
Yes.
Oh, I thought he said pierogies. I thought it was some Italian thing.
Yeah, I have no.
What? Pierogies.
My wife is vegetarian, and she hasn't been complaining about the price of anything so far, but the bills have been somewhat expensive lately, nonetheless.
That's exactly the point, right?
See, like,
So
you see
if
how
there was ever a
Damien-
time to be a vegetarian,
what was I saying? What was I thinking? Oh, we got to get the high price, the 12 point something.
that was meats.
That was
Ryan.
meat.
meats.
Oh, hold it. Just
You
just
got-
generic meats.
Catch up here. It's meats,
Hold it.
poultry, and eggs if you
Yeah.
want the full
Oh.
category.
Geez. I thought. See, here's my problem. I thought he was going to be a lot more clever than that. Didn't you, Ryan?
Yeah, I
Think
mean, I thought
some
maybe
generic
flour.
vegetable and some generic meat, kind of thing.
All right. If you want one for the Super Bowl, 11.6%.
Wings, chicken
Yep.
wings.
Exactly.
Yeah.
Exactly. Frozen chicken
Cowbell.
parts.
All right.
Oh, this.
Yeah, it's a wing shortage.
I know why. Do we know?
I don't know.
All right.
Probably something to
Okay.
do with processing.
Yeah.
Probably.
Anyway, we're having too much fun. I am.
There you go.
Yeah. I don't know why I'm having so much fun. Okay. All right. Damien, hey, Damien, do you want to play this game?
Yeah, sure, I can have a shot. It's going to be a little specialized because financial markets guy, so you can kind of maybe pick the genre. It's vaguely it's going to be inflation related, of course, and related to the main topic.
Oh, here we go. Swap
So-
curves.
Yeah,
So
that's what
let's
I
go-
thought. That's
Yeah.
my mind when immediately went
Let's
there.
go real time.
Okay.
And
Real
so
time.
it's a-
oh, he's looking at his screen, by the way. Real
As
time. When he
of-
says real
as
time,
of
he's looking at
now.
his screen.
Yeah. So
As of 11 a.m. on Friday.
63.7% as of right now.
Is that the
I can give
probability of a Fed rate hike in February?
No.
No, 50 basis points in
50
March.
basis point hike in March. Right?
Correct. Nailed it.
Yeah.
Nailed it.
Oh, that is embarrassing. I'd have to say for Ryan, that's
Come on.
totally embarrassing.
Are you using Fed? No, it's 100%
Feb-
in March.
No,
50
basis
basis points?
point hike in March. It's 100%.
Oh, yeah.
Yes,
50.
Ryan's
Yeah.
correct. It's 100% of any increase, but
Any
it's
increase, right?
Oh,
yeah, I see what you're saying.
Right.
Mhm.
36% of a 25 to 50 basis point increase, and 63.7% of a 50. Sorry, it's I'm talking about the range, the 25 to 50 basis point range versus a 63.7% chance of a 50 to 75 basis point increase.
Yeah.
Now, these same numbers yesterday, the market said 93.8% of a 50 to 75 range. And then a month ago, they said 4.8%. So things have moved a lot.
Yeah.
Yeah, they got whipsawed by Bullard.
Yeah.
Bullard,
That's all good.
St.
What
Louis
does
Fed
Damien
president.
Moore say, though? That's what
Mhm.
I want to know.
In the short term, I
Explain
agree with the
more
market. Short term, I always agree with the market. So we're looking out maybe out to a quarter. I think the market indicators are great for predicting, just aggregating all the information that's out there and sort of coming up with a good, clean forecast signal.
Do you think they're going to go 50 or 25 in March? Sitting here today, based on what you.
I'm going to say 50.
Yeah.
Oh, okay.
What do you think, Chris?
I'm sticking with 25.
25. Yeah.
I think 50 is a panic signal.
That is a panic signal. Do you
Unless-
agree with that, Ryan?
Yeah, I'd say 25.
Yeah.
So markets got whipsawed by St. Louis Fed President Bullard yesterday said that the Fed should go 50 in March or do an intermediate
Yeah.
rate hike, which is they only do that in crisis. I mean,
Yeah,
it's the opposite. They're easing.
Yeah. The only time that happens, last time was pandemic, right? When it hit.
Right.
Right. Yeah.
But then you had other regional Fed presidents come out today saying that, we can go 25 in March. So unless Powell's buying into the 50 argument, they're going 25.
What do you think, Mark?
Well, I think 25. Although I would be willing to have a nice debate about whether it should be 50. My sense is that financial conditions remain too easy compared relative to current expectations the markets have with regard to future monetary policy. So markets are fully anticipating at this point 4 rate hikes, I think, right? This year. Is that
I looked at it was 7 hikes fully priced in by January of next year.
7 rate hikes by January. Okay, so that's what is embedded in equity prices. That's what's embedded in theory, in credit spreads in the bond market. That's what's embedded in cap rates for commercial real estate. And markets they've reacted a little bit. I mean, stock prices may be down 6, 7, 8% from their all-time high at the beginning of the year. Credit spreads, tell me if I'm wrong, but they haven't really risen all that much, have they? Cap rates remain in the commercial real estate market remain incredibly low. And monetary policy affects the real economy, which is what they're trying to do here, slow things up through financial conditions. And also adding to the mix, I don't sense any tightening in underwriting standards, right, in the banking system. If you go look at the senior loan officer survey from the Federal Reserve that was released, I think, last week, it's a survey of bank credit officers. They say they're still easing, policy for seeing commercial industrial loans and consumer loans and credit cards and everything else. So it feels like to me that the Fed needs to really send a strong signal, to investors. Hey guys, we got to, we're moving rates a lot more quickly to get those asset markets to react, to tighten up financial conditions so that it actually has an impact on the real economy.
Well, the Fed's still easing. They're still easing because quantitative easing is still going on.
Well, that's a good point. Yeah. That's actually a good point. I mean, right now they're still buying a lot less bond. It's winding down. It's going to end next week or a couple of weeks, 3 weeks from now. But you're right. Yeah. So I say a quarter point. I mean, I think that's what they're going to do. Mm-hmm. But I would, if I were in that room, I'd be debating, maybe we should go stronger and surprise markets, guide them to a different place so that, we get some tightening in financial conditions because they're not tightening enough to get the kind of growth rates we need. I don't know. What do you think of that argument? Anybody?
The rates have risen though, right? Things are mortgage rates are rising. They're going to have an effect. There's some delay or lag, I would argue, but it's not as
they're
low.
up. So there's been some tightening in conditions, right? The 10-year yield has gone from, it was 1.30, 1.3, 1.4 back a couple months ago. We're now 2. Mortgage rates are up about the same. They were sub 3% for 30-year fixed, are now 3.65, 3.7. So they're moving up. But
and the 2-year jumped just on the talk, right? Of potential 50 basis point hike. So if the market's doing the work for the Fed,
that's what I'm saying. Are they really doing the work? I'm not sure. Are they doing enough?
Not doing enough work. You're saying.
Yeah, enough.
They're doing some.
I'm a little confused why we haven't seen more of a market reaction. I would expect stock prices to be off more than what we've seen. And I think it goes to a lot of liquidity out there, a lot of cash sitting in people's accounts, and they are jumping in when prices go down. So I guess I just feel like the Fed's going to have to give a stronger push, to investors and say, hey, this, this isn't enough. We need to see more of a reaction here. But
Ryan, do you think they can do anything on the QE side to tighten up more rapidly, and that they would do anything at the next meeting?
Well, quantitative easing is going to end in a few weeks, like Mark said. I mean, what they could do is start letting the balance sheet run off. So much, some of the treasuries or MBS on their balance sheet as they mature, just don't replace them.
Right.
And then their balance sheet would start to contract. They could do that, a meeting, 2 meetings after the first rate hike.
do you think, I mean, we've kind of blended into the topic that we wanted to talk about, interest rates, and we'll come back to the game, but since we're on the topic of monetary policy, I've been starting to get some questions about the so-called quantitative tightening. QE is quantitative easing. They buy bonds to help bring down longer-term interest rates. That's coming to an end. Then the question is, do they start quantitative tightening? And that means, allowing their balance sheet, the securities they own that they bought, Treasury securities, mortgage securities, to start to run off, mature or prepay if they're in a mortgage security, or if they really wanted to go into extreme tightening mode, actually selling securities.
That's panic. That's a panic move.
That's a panic move. But do you think just going from QE to QT is that big a deal? I mean, in terms of what it means for interest rates in the markets? I mean, is there something that I've heard questions that, QT is unusual in some way and therefore is going to be more disruptive? Do you?
No, we've done this before.
We've done this before, right?
Yeah, we've done it before. The only difference is this time rates are going to be moving higher at the same time that they're doing QT.
Oh, so if you go back to 2013,
they were paused. I think they were paused for a while.
They were still paused. Of course, Bernanke spooked markets when he started
the taper tantrum.
He linked that to interest rate hikes, I guess, the QT to interest rate hikes, and that spooked markets, and that was now deemed to be a mistake that the way he managed that transition from quantitative easing to quantitative tightening coming out of the financial crisis.
But I think QT will move long-term rates. The term premium is still negative, and usually when the Fed's reducing its balance sheet, it's going to be positive. So the 10-year can go even higher.
Well, let's come back to that because people don't understand. A lot of people wouldn't understand what you just said. So, but we want to flesh that out. But we'll come back to that.
Do we know how much the runoff would be if they didn't replace treasuries or MBS?
$100 billion a month.
100 billion?
But 100 billion. And what's on the, what do they have like 9 trillion on the balance sheet right now, don't they?
Correct.
Or something close to that. And a normalized balance sheet, meaning, where they would actually want it to see in the long run would be half that, really, right?
Yeah, we won't get back down that far,
but that would be kind of the bogey, wouldn't it be? Like 4.5 trillion or something like that. So 100 billion a month, that's 1.2 trillion a year. That gives you a sense of how long it would take to get, at least take 4 years, 5 years of that to get back to, where they would want it, I think. Okay. Ryan, what's your statistic?
All right, I'll give you guys a choice. I have one that kind of up Damien's alley, or I have one that's related to the CPI.
We can do both. Yeah.
All right.
I think let's give Damien a win here. He needs a cowbell. He's never gotten a cowbell, as far as I know. Damien, you ready? I'm pretty quick on these things, so you got to move
two
fast.
numbers.
All right, go for it.
All right, 12% and 8 trillion, and they're related.
12%, 8 trillion, and this is to do.
It's tied to the big topic, rising interest rates, but it's having an impact on this.
Okay, 12% and 8 trillion.
All right, so for context,
Yeah.
it was 18 trillion at the end of 2020.
Oh, 18 trillion at the end of 2020. This has something to do with their emergency credit
Don't think Fed.
facilities? Oh, don't think Fed.
All right,
I'll
I'll
give
give
that
you.
came out this week.
Yes.
I think it's real time. Maybe comes
Yeah.
out all the time.
Yeah.
Comes out.
You can keep calculating it.
Yeah.
Okay.
Damien, do you have any idea what he's talking about? 8 trillion and 12%.
Public debt related.
Oh, you're close. Not public debt. A lot of it's in Europe.
Oh, in Europe.
Mm-hmm. where interest rates recently turned positive.
These aren't like the outstanding covered bonds.
Oh,
or something.
amount of, well,
Huh?
I was going to say negative or debt with a negative interest rate.
Yep.
Oh,
Yeah,
good
Chris.
That's a good one though, Chris. Yeah, Chris, definitely. Yeah.
Yep.
Oh, can
So
you
the
just
market
explain that
value-
then to everybody?
Yep. So the
Explain that.
market value of all bonds with negative yields, so that negative interest rate policy, has dropped an enormous amount given the increase in global interest rates. Now only $8 trillion of bonds have a negative yield.
What was it at its peak, roughly?
Close to 20.
I'm
Give or
surprised
take.
it's still 8. Yeah. I saw German 10-year German bunds are positive 20, 25 basis points, a quarter point, something like that, right? So you're saying, oh, this is outstanding. These are outstanding.
Outstanding. Yep.
Okay,
Yeah,
okay, that
moderate.
makes more sense, right?
Mhm.
Well, no. Oh, that's interesting. It's still 8 trillion. And is that mostly in Europe, or is that Japanese debt, or what?
It's in those two areas, most
in
of
those
it.
2 areas. Wow, that is.
But what I was
really
paying
interesting.
attention to is, you are starting to see some movement in high yield U.S. corporate bond spreads, and now with that search for yield is kind of diminishing. So I wonder if
Yeah.
you're going to see corporate bond spreads start to widen out.
Well, so what's the 12%?
Oh, that's the share of all the value of all bonds outstanding.
That's global non-sovereign debt.
Mhm.
12% of global non-government debt
Has
has a
negative yield.
negative interest rate.
Mhm.
Yeah, and you're saying that's, I guess that must be down from like a third or something.
Yeah, it's down a lot.
Down a lot. Interesting. Oh, that's a great one. That's a perfect one. So what's your other one on the, you said you had another one on the CPI.
All right, this one's easy. You should get this one. 3%.
3%.
Mhm.
Oh, I know what that is.
What is it?
You take the CPI, 7.5,
Mhm.
you X out the amount related to supply chain disruptions.
Okay.
That's 2.5 or something like
Mhm.
that. Then you take out the amount that's related to the mess in energy markets, supply demand imbalance. That's probably another 2.5.
2.
So 2. And so you go 7.5 minus 2.5 minus 2 gets you 3. Did
Very
I get that
good.
right?
Yeah, you got it right.
Okay. Where's the
Excellent.
cowbell?
It's right here.
Okay. Okay. That's a really good thing for people to hear
Mhm.
because that is consistent with what we were saying about the outlook for inflation, right?
Right.
Right. So
Yeah.
a big chunk of of the 7.5% CPI inflation is directly related to the supply side disruptions to the economy,
Particularly
due
for
to the pandemic.
vehicles. And if you look at the month-to-month growth in new and used car prices, it's moderating. So I think that's another reason why we're going to see inflation start to decelerate.
Well, that was a good one. Those were both really good ones.
Yep.
Okay. All right. I got one for you. 61.7%.
Something in Michigan. Yeah. You violated the first rule.
Yeah, that's
Too easy.
too
Yeah,
easy.
University of Michigan.
Okay. And I knew that was going to
89.4.
be easy. Therefore, that wasn't the end of what I was going to say.
Oh,
You
okay.
jumped.
Oh.
You jumped the gun. You jumped the gun. Not really fair. Yeah. When's the last time it was 61.7%?
Oh, God.
I violated the second rule. That's too hard.
So
But
did it get down there during the pandemic?
it did not. That's
Okay.
It's lower than it has been throughout the pandemic.
Great Recession.
Yeah. But here, and I was going to ask because I'm confused by it. There was a big drop in sentiment in the summer of 2011, August of 2011. Obviously we were coming out of the financial crisis and there was still a lot of angst and uncertainty. Does anyone remember what happened there?
Could have been a
what-
was it the high-
hurricane.
Oh, maybe that was it.
Sure.
Yeah,
Let me
something like that.
check.
Was that
Yeah.
the high gas price summer?
Oh, I think we did have higher gas prices then. Yeah, that was maybe played a bit of a role, but it didn't. I don't think they spiked. At that point.
No.
It was
Here's the
Hurricane
other
Irene.
thing. Here's another one. You ready? 97.1.
Are we still in UMISH?
No.
Alright.
Related though.
Oh, no. Did you go CNN back to normal index?
That would have been a good
Oh.
one, but no.
Okay.
That was 89%. That is floundering. I've always wondered, is it floundering or foundering? Or can you say
Floundering.
floundering? Can you say foundering?
I
In your
don't think that's a
Aussie
word.
language, can you say foundering?
Maybe in
Yeah,
Philly.
yeah, I think so.
I think you can say foundering.
Yeah.
Yeah. Yeah. Anyway,
Then you're not a
Uh,
fish.
then you're not.
Right.
That's why floundering I always thought was related to a fish. Yeah, exactly. All right, you guys give up 97.1?
It came out this week.
Indeed, it did.
All right.
I'm
It's not
surprised.
Umish.
Yeah. Ah, okay.
Not
All right.
Umish related.
Yeah, related in the same genre of statistics. That's a big hit.
NFIB.
Oh, you went NFIB.
NFIB. Very
Oh,
good.
yeah, Chris
NFIB.
beat me.
And that was
Yeah.
down. And that's not quite a new low in the pandemic. There was 1 month in the teeth of the pandemic early on when we were lower. And that goes to a broader point, and that is sentiment is pretty weak. I mentioned UMich, the University of Michigan survey, the NFIB, that's the National Federation of Independent Small Business Survey. And then we have our own business survey, right, that we've been doing every week. And it's down a lot. It's actually, we asked 9 questions to the respondents, and then we create a diffusion index, the percent of positive responses less negative. And we were firmly positive, from March of last year to basically last week, a couple of weeks ago. We are now negative again. So, people are nervous, and sentiment is on edge, and that just shows you the corrosive nature of high inflation. I mean, that really bugs people. Really makes them nervous. It's almost like that. I think people feel. And maybe they're right. They're just getting ripped off, right? Because I'm paying $275 more a month now for the same stuff I was buying a year ago. How's that possible? How's that possible? But that just goes to show you how worried people are.
Well, Umish got the double whammy because it's really sensitive. The questions they ask to personal finances. And yet
Yeah.
The stock market's down and gas prices are up, and that just is going to crush Umish.
Just crush UMich. Yeah, the University of Michigan.
The 1 year
Okay.
outlook for inflation was 5%, right? For
It was
Umish.
the
Yeah,
1 year.
So consumers
yeah.
are thinking this is
That goes
not
back to gas
gonna-
prices, though.
Yeah.
They very, very tied to gasoline prices
And food prices.
And food, yeah. Yeah, very good. Okay, that is the game. I actually had another pretty good one, but we're kind of getting short on time. Should I do the other one? No.
Yeah.
We'll move. Should I? Really?
Yeah, but we'll do it quick.
Okay. I'll make it easy. Okay. It's related to inflation. And there's 4 parts. Each part is a little harder than the previous part. Okay. Damien, are you playing? I see you're looking away. I don't know.
No, I'm listening and just
He's
trying to-
concentrating.
Yeah.
It's my thinking.
He's-
Thinking.
Damien's playing Wordle.
Look.
Thinking. All right. 7%. Oh, excuse me. 7.5%. Sorry.
Mhm.
Okay.
What's
Got
that?
that one. Headline, CPI.
Headline consumer price inflation year over year through January. 6%.
That's
Core.
core.
5.4%.
Median.
No, that's a good guess.
Are you
though.
sure?
Yeah.
Oh, trimmed?
That's trimmed.
Okay, trimmed. Mhm.
So this is, I take off the goods and services whose price increases were in the top 8% of the distribution and the bottom 8% of the distribution. That's called the trimmed mean, and that was 5.4. Because the thinking is, you got some of these outliers that month to month might screw up the underlying message in the data. So throw those out. So 5.4, 4.25. 4.25%.
Median.
Median. Very good.
You know
That
also,
definitely
do
just-
you know what else was also 4.25?
What?
The sticky CPI.
Sticky
And that just
CPI.
looks at-
Explain that one. Explain what that is.
That looks at the CPI based on components that move, like price changes move slowly. So this is kind of like a persistent inflation that's going to linger for a period of time.
Yeah, and rent would be in there, for example. what
Correct.
Chris was talking
Yep.
about. Yeah. Okay, well, that gives you a sense of things. So, obviously, things are all juiced. They're going to come in, but it does feel like kind of the underlying rate of inflation is certainly moving north here. So something to worry about. Okay.
Mhm.
All right, let's talk about interest rates. We talked about monetary policy, and so just to round that out, in our baseline, this is our collective view. I'm just going to lay it out. Tell me if we kind of talked about it, but we have the Fed ending QE, bond buying soon, next few weeks. We have them QTing, letting the quantitative tightening, letting their balance sheet run off beginning in June. We have the first rate hike, percentage point at the March meeting of the Federal Open Market Committee, the policy committee of the Fed. That's mid-March. And then they raise each quarter a quarter point. And we have that in our forecast in 2023 and first part of 2024. And they get the funds rate target, the key rate they control, up to 2.5% by mid-2024, and that's the long-run equilibrium rate, so-called R star. That's where things settle in. Okay, that's our baseline. Anyone think that we should change that? Should we, and I don't think anyone would say make it less aggressive at this point, but that's kind of where we are. Damien, do you have a view on that, or Chris, Ryan?
Well, you already pinned me down on my next
in the 50 bips.
next quarter forecast. So.
Yeah, and you're near term, so you don't want to go. You don't feel comfortable going beyond that.
So historically, I've always thought we've been too aggressive in anticipating rate increases. This time around, I think maybe we're too slow because I feel like the inflation concern is real, and that it could be a lot quicker than we think, and probably will be.
So 50 basis points in March, and maybe more rate hikes through the remaining.
I'm definitely on the fence about March, but I feel like it's probably going to be a bit quicker through the summer.
Yeah. That's an interesting observation. I think in my mind's eye, it feels right that we've been, in other cycles, we're a little quick to expect the Fed. Certainly that was the case after the financial crisis. No doubt about that. Mm-hmm. Yeah. Okay. That makes sense. So Ryan, Chris, are we, I guess, similar to what Damien, yeah, okay. Yeah, kind of the risks are to more rate increases more quickly than we have, in our baseline view. Yeah, makes sense. Okay. All right.
I mean, they're in a bind in March. They can't win this one because if they raise by 50, it looks like they're panicking.
Right.
They raise by 25, then market concerns they're behind the curve even more. So March is just a no-win situation for them.
Unless they start telegraphing now, right?
Yeah.
They could
control the communication.
Yeah.
Right.
Right. They still have time, right? We're a month away, so there's still plenty of room here for them to do that. Yeah. Okay. Okay. Let's turn to the 10-year Treasury yield, and let's talk about that. And Damon, do you want to give us a lay of the land on the 10-year? Where are we? Where we've been?
I'm not really a lay of the land guy. I think Ryan is better.
Ryan should do it. Okay. Yeah. Ryan. Yeah. Where are we? I didn't look
see
today.
See what he does? I told you. He just throws more work my way.
Under the bus, Ryan.
Yeah.
Hey, do we really want Chris to do this, Ryan?
No, Damien's just got to be careful. Damien lives right down the street from me, so jeez. I know where he lives. So long-term interest rates. So the 10-year Treasury yield has jumped recently. I don't know the exact increase off the top of my head, but we've talked about this in past podcasts. When you break down or decompose the 10-year Treasury yield into its three main components, so inflation expectations. This is market-based inflation expectations. The expected path of the real short-term rate, and then something called the term premium, which is the extra compensation that investors need to hold long-term treasuries versus short-term ones. So when you break it down, the recent increase is mostly, almost entirely, because of an adjustment in the expected path of real short-term rates. And then that gets back to monetary policy, Fed signaling that we may have to be a little bit more aggressive to curb inflation. So what's really driving both ends of the yield curve, the long end and the short end, is monetary policy.
Right. So the 10-year is Treasury yield, kind of the benchmark interest rate, long-term interest rate, is sitting around 2. Let's just use 2, correct, give or take. Yep. And that's up a lot. It was, I think it rose 0.1%, 10, 12 basis points yesterday. That's a big move in the bond market. And if you decompose it, the 2%, inflation expectations are sitting just south of 2, I think, like 1.75%, I believe. And by the way, that's come down, right, from where it was. I want to come back to that in a second. That means that real short-term interest rates plus the term premium are still negative, right?
Yeah, they are.
They're still negative, which seems a little weird. So there's a lot of weird things in in that decomposition. First weird thing is, why are inflation expectations going down? And by the way, adding to my confusion, historically, and you're the one who pointed this out to me, Ryan, is that those market-based expectations are closely tied to oil prices. So when oil prices go up, you would have expected inflation expectations to go up. And we've always found that mysterious, but that is definitely true. I heard a really good bond guy yesterday when I was talking to that group of economists mentioning this anomaly. So what do you think is going on there? I mean, why are inflation expectations embedded in the bond market going down when everything's screaming that they should be going up? Do you have any idea? I don't know. I'm confused by it. Does
Damien,
you have any sense of that?
No, it's really puzzling. I think it's an enduring puzzle. Like inflation expectations in the long run haven't really moved at all. And that's the numbers you're quoting are, I guess, the tips.
Well, I was thinking five-year forward.
So
yeah.
And so the five-year forward is pulling out just the part of inflation expectations that look ahead in 5 years' time, basically. And so I think some of that speaks to the secular stagnation type argument that we have a temporary transitory bout of inflation that we need to address because we have an overheating economy relative to where it needs to be today. But over the longer term, we still have all these other demographic and other factors that are slowing growth that will keep inflation pretty low.
Yeah, that makes sense. I mean, it's almost like what the bond market is saying. When I say bond market, investors who are putting their money where their mouth is. And five-year forwards, just to explain it again, you look at the 10-year yield and it's inflation 5 years from now over the subsequent 5-year period. So this is, abstracting from all this mess that we're in right now. It's in the long run, where will inflation be? And that has not moved up and has actually moved down. Could it be the case that this is a signal that bond investors think we're going to have a recession or some really tough economic times, down the road? Because they're saying, okay, we got all this inflation now, and that's the reason to think that the Fed's going to step on the brakes really hard, misfire, push too hard and push us into recession, somewhere down the road. Inflation is actually going to be lower than it is now. Is that, am I reading way too much into that?
I don't think so. Your favorite recession indicator, the yield curve, is flattening out.
That's right, but it's not you're
negative
right.
yet.
It's not negative.
It's
not short rates have not risen above long rates by a long shot, right?
Mm-mm.
But you're saying that has flattened. Short rates have gotten closer to the long rates. So that's a signal that bond market investors are thinking the economy is going to be weaker down the road. And then that would be consistent with the idea that inflation expectations are tame and gone down. That they think the the charitable interpretation is the Fed got control over this. They've got us. They got our back on inflation. They're going to figure this out one way or the other. They're going to get their target. The non-charitable or less, the more worrisome interpretation is that they're thinking they're going to step too hard and push us into some kind of really weak economy or even a recession down the road. Maybe that explanation squares the circle here. Does that make sense?
At least the probability is higher, right?
Yeah.
Mm-hmm.
It doesn't have to be binary, right? If they just think that the odds are higher now,
yeah, just the odds are higher. That would be
sufficient.
Right.
Yeah.
All right. Well, here's the other thing, and this goes to the outlook for 10-year Treasury yields. Inflation expectations they're not, they are where they are. I don't think they go lower. They're pretty consistent with where the Fed would want to see them. But to have the real short-term interest rate and the term premium negative, that doesn't make sense in the long run, right? In the context of everything we know, I think. That's a statement. I'm curious what you think about that. In terms of Fed policy, it feels like it shouldn't be negative real rates, should it? I mean, that should be moving higher. And in terms of the term premium, that's a compensation that investors get for investing long run versus short run. That shouldn't be negative, right? Should it? No. So doesn't everything I just say argue for even higher long-term interest rates?
Higher than today? Yes.
Yeah.
Mm-hmm.
So they're going to be moving up. Yeah. Hey.
So A
Go ahead,
conventional, let me just jump in real quick on the
Yeah.
term premium part. So a conventional, so we used to think before the financial crisis that the term premium was basically this pretty stable thing, and it was always positive, maybe around 100 basis points of spread between short-term rates and long-term rates over a business cycle where sort of the moves in the different rates even out. And post-crisis, that term premium, by all estimates, went negative, or at least went much lower than 100 basis points, and has stayed very low and negative for over a decade. And one of the explanations for that, a very financy sort of explanation, is it's related to inflation risks.
Yeah.
And that
Right.
when inflation risks dip towards the pessimistic side, where inflation might become deflation, then it's actually good to hold treasuries, and you'll be willing to accept a lower term premium or even a negative term premium because you're sort of going to receive a payoff in fixed nominal dollars that become more valuable if inflation underperforms. And so that's one explanation. So that the balance of inflation risks are going to remain tilted towards the downside will keep the long-term treasury yields lower than they should be.
Oh,
Now,
I thought. Okay, sorry. Go ahead.
Now, there's another factor, which is we've had a big regulatory shift after the financial crisis that's created all this extra demand for treasury debt. And I'm sure that has to have some impact on where yields come out, where long-term yields come out relative to short-term yields.
Yeah. So I thought you were going to say something a little bit different on inflation. My sense is that built into the term premium is some compensation to investors for the volatility of inflation, and that post-financial crisis, inflation was low and there was no volatility. You know, we weren't even thinking about it. But now, volatility is the name of the game. There's a lot of volatility. So you would think that would add to the term premium, right? And then on your point about treasury demand due to banks and other financial institutions needing liquid assets on the other side of the financial crisis, that's in the market, right? That can't be getting bigger, can it? I mean, that would be getting smaller, right? So both those things you just said, I think are, well, you said something a little bit different about inflation, the inflation part of the term premium, but everything seems to suggest that instead of being a drag on the term premium, making it more negative, it should be less of a drag and allowing it to go more positive.
Yeah, so the unfolding, like the latest sort of data where we have this idea that we're going to have this bout of inflation, that should be bringing the term premium up, and it's not, and that's a puzzle.
It's a puzzle. Yeah. All right. Well, just here I've got, we are running out of time, but I want to run one other thing by you, and this goes again to the forecast for long-term 10-year Treasury yields, long-term interest rates. So if you look at our forecast, we have the 10-year Treasury yield rising in an orderly way over the course of the next 2.5 years, similar to the increase in the funds rate. And we settle in, the 10-year yield settles in the long run at 4%. So we're at 2 now, we double, over this period. Obviously, interest rates don't move in a straight line. They go up, down, they go all around, all over the place. So this is not going to be straight from 2 to 4, but that's where we're headed, and that's where we're going to settle. And the anchor here has been, at least my thinking, is that in the long run, when the economy's at full employment, inflation's at target, we're growing at potential, the world is, orderly and equilibrium, that the 10-year Treasury yield should equal the nominal potential GDP growth in the economy. And empirically, in the long run, that holds. If you go back 60 years and you say, what's nominal potential GDP growth, and you look at the average of the 10-year Treasury yield, it is, I'll tell you, it's equal to the basis point, 4.62%. They're exactly equal. So that's kind of sort of where we have things going. Does that framework about thinking about long-term interest rates and where the 10-year Treasury yield is headed, does that resonate with you? Does that make sense to you?
So I think in what you're saying sort of very much lines up with sort of the natural rate models and the story in the
exactly.
natural rate models,
That's the
right?
natural rate model. Yeah.
That when growth is strong, interest rates should be strong too. Growth is high, interest rates will be high. But then you look at the last decade of what the natural models predict, and there's a real sort of break in the linkage between growth and what the natural rate models are saying, that interest rates are so much lower than what the long run growth outlook looks like. Like the long run growth rate has come down since the Great Recession began, but not by as much as the natural rate has really come down.
Okay, let me say, agreed. There can be long periods of time when 10-year Treasury yields do not equal nominal potential growth. So go back into the 70s and 80s when the last time we were suffering a wage price spiral, inflation was out of control. The Fed said, enough of this. Paul Volcker was chair of the Fed. He said, I'm going to crush this thing. And so you had interest rates that were above nominal potential growth, you know, as the Federal Reserve worked hard to get inflation expectations down. Flip of that is after the financial crisis, we were deleveraging. The banking system has to capitalize, has to gain liquidity, and that's a global event. That's not just a U.S. event. And the central banks, the Fed, were working hard to get inflation back up. It was too low. So they kept interest rates were low, but the 10-year yield was consistently below nominal GDP growth. So agreed, you can have long stretches of time when these things things lined up. But in the, you know, the sufficiently long run, that these things have to, you know, these things roughly equal each other. And that's kind of the anchor in terms of, you know, the what's in our long-term forecast for long-term interest rates. Does that resonate?
I certainly agree that growth rate should be a kind of core part of what your long run view of long-term interest rates should be. And then there are some other factors like the relative sort of value, sort of safe haven value of the dollar relative to other currencies might have impacts on that over long term. Like some people think the dollar is going to lose some of its value there, and that would tend to sort of raise interest rates a little bit. But then there are countervailing factors that might go the other way. So,
yeah. Okay. Well, we are at the end of the podcast, but before we end, we're going to go on the record. By the way, I think in one of these early podcasts, we were talking about 10-year Treasury yields, and we were doing the same forecasting. And I think I was on the right side of this compared to, like, well, Chris was in the middle. Ryan, I was saying rates were going to be higher. You said they were going to be lower. Did I have that right?
We got to go back and check.
I
I don't know about that. I was lower than you and Chris.
All right, fair enough.
You were definitely lower.
But we are definitely going to go back and check. You know, April marks the 1-year anniversary of our podcast.
We'll go back and look.
We're going to go back and look. Oh, okay. So let's do the forecast. Okay, so you heard my forecast, right?
4.
The funds rate goes from 0 to 2.5%, kind of in an orderly way between now and mid-2024. The 10-year Treasury yield goes from 2 to 4%, not in a nice orderly way, but, you know, up and down and all around, but gets to 4% by mid-2024. So what do you guys think in terms of that outlook for interest rates? Anyone want to take another side?
I'll take the low. I think
You'll take the low. Okay.
I think your rule of thumb, where 10-year equals nominal GDP, I think that applied 50 years ago, but times have changed. Market's much more global. So I think it's going to be less than that, right? You have to. I think I would average in, say, the rates on bonds, for example. As an example.
Reasonable. That's reasonable.
So something south of that, maybe 3. Let's go with 3.8.
Oh, geez.
Right. All right. 3.5, 3.8, somewhere in there.
Talk about prices right. But okay, fair enough. Oh, that's a reasonable argument. Damien, any perspectives on that? On the outlook, or do you have a view?
Are we talking about the 10-year specifically?
Yeah, or I have the funds rate at 2.5. That's R star equilibrium and 4% on the 10-year. Long run.
So long run for the 10-year. I think it's low.
This.
I think it's going to stay low. I think it's going to stay under. I have a hard time believing we're going to see 10-year rate above 3% anytime soon.
Okay.
Wow.
Very interesting.
And part of that reason is like sovereign debt globally is massive. And
Mhm.
I think there's going to be a strong push to keep interest rates low and manufacturing in a way that doesn't cause inflation to explode.
Yeah. Okay.
So I'll say
All right.
2% Fed funds rate, 3% 10-year.
Okay. So you're in the Damien camp.
Yeah, and I'll give you a non-trivial possibility that the Fed funds rate's back down to 0 by mid-2024.
Well,
Right.
I'm on board with that actually. I mean,
Yep. This is a boom bust
The
cycle.
boom bust, yeah. I mean, we talked about this last week or the week
Yep.
before, but yeah, you're right. That's definitely got a probability to it. Yeah, and then we'll never get to 4. Jeez.
Nope.
Okay. All right. Well, we got a lot to think about. We're on the record again, so we'll see how this plays out. And Damien, we're going to have you back. Thank you for participating. Very good of you. And guys, any parting words? Okay. Okay, we're gonna. You know what? I didn't hawk my at Mark Sandy, did I? The Twitter feed. And Ryan, you're tweeting a lot. I've noticed. So
I've gone down a rabbit hole. You pulled me into this rabbit hole.
well, you got to be careful about that. You got to be very disciplined about not going into that rabbit hole too far. But
So I only do it. Like, I have like scheduled. At the end of the workday, I'm like, all right, I'll put up 2 or 3 tweets.
yeah. See, I don't do it that often. That feels like too much to me. Yeah.
Mhm.
But if you're a young guy, you can do it.
Not that young. Mm-mm.
Yeah. What's your Twitter handle?
At realtime_econ.
There you go. Okay. Thanks so much. Take care. We'll talk to you soon. Bye-bye.